Everybody talks about investing in real estate, but very few people tell you what you should invest in or how you should do that or what it actually all about. I have specifically stopped investing in single family rental just because of my personal preferences, and I love investing in multifamily. And in this presentation, I actually break down how to invest in multifamily, what exactly are the pieces, and how it can benefit you. I do this for a special mastermind group, and I share this whole presentation with you right now. So here's the gem. I learned this idea about, I stopped thinking about money in the bank. And I stopped thinking about money in the bank because one of my mentors told me, he's like, Sharran, you don't want to count like everyone else is counting. You want to count differently. He said, you want to count differently. And I said, what do you mean? It's like everyone counts by the income that they made this month or how much their business is doing on their P&L or the size of their house, and all that's good. But he goes, if you really want to grow your wealth or you're thinking about wealth, you have to find a way to think about net worth. Because at the end of the day, if anything happens and the world goes to hell in a handbasket, your net worth is what's going to actually protect you, save you, etc. So he goes, don't have to do anything else, just start tracking it. So this was about 20 years ago. My partner today, he's 68. He's my mentor for the last 20 plus years. And he's like, just start tracking it. So every month, for the last 20 plus years, I've just been tracking net worth. And it's funny, right? Whatever you measure improves, and whatever you measure and report improves exponentially. Say it again, whatever you measure improves, whatever you measure and report improves exponentially, which is why I want to title this the Ultimate Net Worth Accelerator. So here are the three things we're going to talk about today. I'm going to give you a framework. If not anything else, I'm going to give you a framework to evaluate any investment quickly. I'm going to give you a framework to evaluate any investment quickly. Second, I was an investment banker at Goldman Sachs. So I'm going to give you what billionaires do to analyze anything. What are the things that they're all human. What do they do differently that we don't know? And if I could give you a model that they utilized, why wouldn't we utilize that, right? So that's a really good, so I'm going to actually give you the model that I learned that I've been using for the last 20 plus years that you can very quickly figure out and utilize yourself. So I'm going to share that with you. And third, I'm going to give you a blueprint for how to execute on that right now if you're interested. Hey, I'm interested in investing. I'm interested in thinking about it. I'm interested in putting something my 401k IRA somewhere. I'm interested. What do you do for next step? So that is our kind of jam for today. All right, Sharran, blah, blah, blah. Why is all of this important right now? I love Jason and Doug, so I came on the call. This is cool, but why is all of this important right now? Well, let me tell you, there's three big reasons why this is really important right now. I learned a lot of this by losing money. So I'm going to tell you, I don't even know most of you but I'm a better investor than you for one reason. I have lost more money than you, all right? I have lost more money than you. There is no way you have lost more money than me. And that's a really sad thing, by the way. And that I've learned a lot from that. So a lot of what I'm going to share with you is I've seen the ups and downs of multiple markets. I've lost a lot of money, and I want to make sure that, and based on that, it shaped a lot of decisions. And so learning that way, like how many times have you ever been, something bad has happened, something you've gotten hurt, and you're like, oh, I only wish I'd known that sooner. Well, I'm going to give you a wish I had known that sooner a lot today. All right. So number one, I'm going to share that because that's what's really important right now. Number two, I promise you, there's a ton of bad information out there. Right. I think recently, and Jason talked to me about this. So you guys got in one of your last presentations, a little checklist of the questions that you'd ask people if you're investing in multifamily so they don't take you for a ride. That's really good. I'll actually go through those and how to actually think beyond them. I'll answer those for you so that you can actually, the problem is not in the answering of the questions. The problem is in the dumb questions that people tell us to ask, right? And I'm not saying that those are bad questions. I want you to find a framework to ask better questions. And I'll show you what that is because I promise you, there's a ton of bad information out there, right? And last but not least, we're in a really shifting market right now. And I will promise you, there's a lot of millionaires being made right now. And you may think one of two things. You may be like, hey, you know what? I really wish I had a stockpile of cash right now to invest when the market goes down. Has that thought ever crossed your mind? I really wish I had a stockpile of cash. So there's two positions that you and I are going to be in right now. And I want you to choose one of the two because we should not have any FOMO. Position number one, you have what we call dry powder, liquidity, cash to invest right now. And you're going to take advantage of some opportunities that are going to happen in the shifting market. That's fine. That's good. The second boat is you don't have that, and that's okay, but you're going to learn whatever it takes. You're going to have it, that mindset and that idea. You're going to learn it so that the next time this happens, you're a pro at it. We have to choose one of those mindsets to be in. And either of those mindsets are cool. And I'm going to help you like learn that today. All right. Awesome. Cool. So you'll be like, all right, Jason said you're cool. Why should I care about you right now? Why should I care? And because you can be like, hey, you're going to tell me that what someone else told me something at the opposite of what you told me. Why should I believe you over that someone else? Who the heck are you, dude? So let me give you a little background I do like 3 things and I do them really well. If you ask me about Bitcoin, if you ask me about goat farming, if you ask me, like, I don't know that stuff, right? But what I know really well. And I'll tell you how I got there. So I invest for a living, which means, as my wife says, I lose money for a living. That's literally what she's like, oh my gosh, man, you wake up every morning and you're like figuring out how to lose more money. Like, you're the weirdest husband to have. So I invest for a living, which means I know more than you, which means I lose more money than you. So please take my lessons. Number 2, I've lived through multiple downturns with money at risk. All right. Even though the Asian genes may feel like I am 23 years old, I am not. All right. So just FYI on that. I have a undergraduate degree and an MBA from Vanderbilt. So I've done way too much school, and I hope I never did that much school. So for those of you who think that educational pedigree is important, I just want to make sure you know I checked the box. I also did a PhD at Stanford that I dropped out because I built a business. Don't ever do that because I spent too much money doing that stuff. I built a company in Silicon Valley that was bought by a publicly traded company. So I went through that process, and there was a lot of free money there. So I learned how to do that. I was an investment banker at Goldman Sachs. So I had 39 one-on-one interviews to get a job at Goldman Sachs, 39 individual one-on-one interviews. None of you have done 39 individual one-on-one interviews for anything, right? And then I worked at a Swiss bank called Credit Suisse, which is the #1 Swiss bank in the world. So actually know how the banking system works. We were on the Inc. 500 list for one of our companies 4 times in a row. We are one of like 6 companies in the world that has done 4x Inc. 500 4 times in a row. I've had 5 company exits in the last 19 years. So, and multiple failures, which means that I've lost more money than you. I'm trying to tell you the same thing over and over. I've lost more money than you. So please listen. Our last big business was Telos Properties, which is a real estate business, which is why I'm actually kind of sharing. I'll tell you how old I am in a second, which is I'm sharing. So I built a real estate business. We had a business in Southern California that we started at 33-ish agents in 1 office. We grew to 700 agents and 22 offices in 5 years. So we grew at 10x in 5 years to $3.4 billion. And we were the largest exit by a publicly traded company, bought a private company in the history of the United States. So all I'm telling you is, like, I know the real estate business and I know it really well and intimately. Right now, I run a private equity fund called Highland Prime. All I do is I take minority stakes in companies and I help them grow. I'm an operator. So you've got visionaries and you've got operators. All right. I'm an operator. I care about operating a business to make it grow. I don't pontificate about how great the world is, mission, vision, values. I don't care. That's not my jam. My jam is how do you take a business and how do you make a ton of cash? And then my wife says, you're really good at making money in the business and then you lose it all in your investments. So again, I want to let you know that learn from my mistakes. Okay. Our current portfolio companies do roughly 122 million. So we've got a good track record on all of them. One of the businesses that I operate is called the ARC Multifamily Group, which is we invest in multifamily real estate only in the Southeastern United States. We are not syndicators. Syndicators are slime. I'm telling you again, syndicators are slime. Okay. We are not syndicators. You don't want to work with syndicators. Syndicator bad. Okay. Operator good. Say it again. Syndicator bad, operator good, right? So the distinction is really, really important. Okay. We've invested over $100 million in the last 12 months. So please know there's a lot of capital at risk on where all this information is coming from. So based on all of that, I am 42. I'm 42. I have 2 children. My son, Neil, is 10. My daughter, Laura, is 6. My daughter, Laura, runs the house, which, of course, that's how things work. She likes unicorns and rainbows, which is actually true. I never thought little girls like unicorns, but she actually likes unicorns and rainbows, which is fascinating. Yeah. Julie says, stop thinking about money in the bank and start tracking your net worth. Yeah. By the way, you don't have to share it with anyone else. Just start tracking it and you'll start to realize what decisions you make around it, right? Which is super important. Shelby says you've done a lot. Oh, I appreciate that. Like hey, when you're driven and motivated, my parents sold everything that they had. I was born in India. My parents sold everything that they had to send me to the US to have a better life. And I'm super grateful for that. And you just realize that you're a land of opportunity. You can learn, build, and grow. And the best joy comes from, sharing and giving back, which is really good. Net worth, what's in the bank, is really good. Measure and improve. Yeah. The quote is, whatever you measure improves. That's what everyone else says. But whatever you measure and report improves exponentially. Right? That's why the accountability of measuring and reporting is really good. Cool. Awesome. All right. Yeah. Do I have your permission to actually share with you a couple of models that you may be able to utilize? Okay. I can't believe I said that, Giovanni. Syndication. Yes. But syndicators, bad. Right? We'll get into that in a second, and I'll tell you how to smoke a lot of people out. What syndicators do, just FYI, a very high level, what syndicators do, not everybody, there's an 80-20 rule. What 80% of syndicators do that give multifamily a bad name and put your capital at risk is they'll say, ooh, Julie, give me some money. I'm raising money for this deal. This is a fantastic deal. Chris, give me some money. This is $100,000 minimum. It's a fantastic deal. So they put all this money together, right? And then they go try and buy an asset. So it's $10 million. They try and raise $2 million from a bunch of people. They go and try and buy this asset. But a syndicator, all that the syndicator cares about is trying to figure out the deal so they can get a fee from buying this asset. Their fees baked in. So once they buy this asset, your money is in this asset till this asset performs. But the syndicator makes money today, right? I'm not in our investments. I won't make a penny for 5+ years until all of you get paid back. And that's the big difference, because we operated like a business. A big part of what a syndicate, last key here, the verb syndication, syndicate is good. The noun syndicator, bad, right? Syndication is the idea of pooling capital to buy a good asset. That's syndication. Syndicator is someone that pools capital to buy an asset without your knowledge, grabs a fee, and then really doesn't care, and they don't operate the asset. We own and operate every single asset. We run it like a business. That's the big difference. Syndicators just go from deal to deal, raising money, and then they take their fee. And whether the deal does well or not, it's not their problem, because over the years, real estate's always gone up, and so they've been okay. That's the problem, right? So syndicator, noun, bad. Syndication, verb, good. Tina asks, how do they make money right away? Let me get, Tina, could you save that question, and I'll explain it while I show the structure. That way you actually understand it within the structure of everything. So save that question. I promise I will answer that because it's super important. All right. So two things I'm going to share with you right now. So let's actually kind of go to that. Here are some quick problems we should think about. Okay. Problem number one is a lot of these financial people, right, will hide behind fancy PowerPoint. So let's not do that. Right? There's no fancy PowerPoint. Number two, most of our financial will not give you any details. Oh, we've got this great fund and you could do really great, and look at our track record. Right. Third, we, like most financial people and PowerPoints, specialize in vagueness. They'll put up a slide that has 400 million things with graphs going up and to the right. And you're like, look at my stuff. So vague. It's if that's ever happened, you can just shake your head. This is, just so vague. We don't want to do any of that, because when we see stuff like that, it just seems too complex to want to even get involved, but we don't know anything else because our business is making money and we don't know where to stuff that money for it to grow outside of our business. Instead, I want to tell you what the opportunity is. The opportunity is, I'm going to give you a chance to see our entire business model here. In fact, I'm going to take you behind the scenes, our business model, and give you a chance to build your own. All right. Number two, I'm going to show you how the structures and the numbers work. Literally, I'm going to say, hey, here's the structure, here's the numbers, here's how someone makes money, right? And number three, I'm going to take each of the puzzle pieces and break it down for you. So you're like, that's what's broken. That's where the opportunity is. That's what this word means, because you'll get a lot of jargon thrown at you, right? And you don't need to know 100 things. You need to know 4. And I'll just tell you what those 4 are. And here's the interesting part. You don't even have to ever look them up again. I'll tell you what they are, and you'll remember them for life, because I'll draw a bunch of pictures like a really weird piggy or a big tree, and you'll know exactly what that is. Cool. Awesome. But this is my goal today. My goal today is for you to be able to understand what I'm teaching you so well that you can teach it to anybody else. All right. That's my goal for you. My goal for you is if you can teach it, there's a great Jim Quick quote. He says, when you teach something, you get to learn it twice. Which is a cool quote. When you teach something, you get to learn it twice. So my goal is to teach this to you so that you can teach it to someone else. All right. Game plan for today. Game plan for today is this. Going to show you 3 things that we're gonna do. Now, number one, I'm going to put my chat right here so I can see you all. Number one, I am going to, well, I lost you. All right. Number one, I'm going to show you how to analyze any deal. Doesn't matter if it's a pineapple farm, doesn't matter if it's Bitcoin, doesn't matter if it's real estate, doesn't matter if it's Apple stock. I'm going to show you how to analyze any deal in a very quick matrix. I've taught this to most of the CEOs that I mentor. You will see this model on YouTube that a lot of the influencers use without crediting me. And that's okay, because as long as they're getting good information out, I don't care. Like, so totally fine. And I'll tell you all about it. Number two, I'm going to tell you about the multifam space and exactly how to think about multifamily and why it's important. And number three, I'm actually going to give you a breakdown of some numbers so that you actually understand how it works. And most importantly, even if we only have like a few minutes left, and for some reason I get too carried away, I want to show you this one thing that will completely change your life, that has completely changed my family's life, that if I had learned this one thing 20 years ago, the trajectory of my life and career would not be linear, it would be exponential. All right. So I'm going to, if not anything else, I just one thing before we go, I'm going to show it to you. And you're going to be like, I'm glad Sharran showed me that one thing. And this is called the 5-year double. And my entire presentation, my entire idea is to get you ready to understand the 5-year double. So the whole thing that we're going to do today is, if you can understand this 5-year double, you win. And I have this. So that's my last slide. So I'm going to break it all down for you. So here, let's actually go through and break a few things down. First off, the stuff that nobody taught us. Nobody taught us how to analyze an investment. Nobody taught us any of this stuff. So I'm going to give you a way to analyze any investment, and I'll give you some examples around it. All right. So whenever you think of any investment, you should be thinking of four things. Yeah, you can write this down. I'm happy to send you these slides. Thing number one is capital preservation. I'll give you an example in a second. Okay. Thing number two is tax efficiencies. By the way, I'm assuming all of you are in the US or Canada. Crazy part is this: taxes are the biggest drag of all wealth creation. Let me give you the best tip that you can ever get. Don't invest in anything. Here's my best tip that you can ever get. Okay. If you have the courage to do this, I don't think you can, because you guys own salons around the country. If you can move to Puerto Rico, you win. And let me tell you why. Did you know that Puerto Rico has a 3%, 2.7% flat tax? For $100, you pay $2.70 flat, and you're done. You get to keep everything else. Isn't that crazy? When we wake up in the morning, you're in Puerto Rico, and it's not bad, right? It's not bad. Like little, for us Californians, I live down in Laguna Beach, California, a little sticky, but I have had two of my portfolio partner companies move to Puerto Rico. Literally, they doubled their income with changing nothing, right? It's pretty wild, because if you take 50% in taxes, expenses, et cetera, they go flat. So taxes are the biggest drag. All right. And that's number two. Number three, there's a word called yield. And if you don't know what it is, I'll explain it for you. The common word for that is cash flow. And by the way, very, very hard to generate. People that tell you, "Ooh, you need to get passive income. Passive income is your lifesaver." Like, do you know how you can get $30,000 a month in passive income? It's hard. It is very, very hard to do. There are very few to get 30,000 in passive income. You got to put up like $2 million. Like, it's crazy sometimes, right? Actually, that's not the math, but I'll walk you through the math. Cash flow, right? Number four is growth. And growth in the technical word is equity, which means that, hey, you have ownership in something. So when it grows, you make money. All right. So please, so anytime someone asks you something, you need to put it through these filters. So let me walk you through an example. I'll walk you through a very interesting example. So how many of you know, just give me a wave if you know the Dole Pineapple Company. Dole Pineapple Company. All right. Dole, if you didn't know this, Dole bought 80% of the island of Lanai. I don't know if you know that. There's a little island outside of Maui called Lanai. I used to live on Maui. And so there's a little island, and they bought all the land up on Lanai. There's, outside of what Dole owns, there are only two resorts. It's called the Lodge at Koele and Manila Bay. There are only two that are run by Four Seasons, right? Everything else Dole owns. So let's say you owned let's say you were thinking about investing in a pineapple farm, right? So let's say you think about investing in a pineapple. You're like, man, I thought he was going to talk about like multifamily. He's talking about pineapple farms. Like, what is wrong with this guy? All right. Pineapple farm. So first question I'd say is, let's put it through the lens of capital preservation. Do you believe and our goal is to score each of these on a scale of 10. Okay. We're going to score each of these on a scale. In fact, I'll make it even easier. Let's score each of these on a scale of 25 so we can make it a total of 100. Capital preservation. Do you believe that if you own a pineapple farm on Lanai and you paid, pick a number, $100,000 for it today, do you believe that it's not going to go to zero? Would that be fair to say? Right? So out of 25, I'm just going to go really easy. I'm going to give it a score of 25. Okay. That it's not losing value. It's land, right? It's fine. Tax efficiencies. Do you get any tax efficiencies for owning farmland on Maui? FYI, just so you know, the U.S. Agriculture Code gives you insane agricultural subsidies for owning agricultural land. So maybe you get a 10 points for that. Not great, but 10. I'll take 10. Yield and cash flow. What do you get yield from this? Hey, you sell pineapples. It's really good. You get a sell stuff, which is awesome. So you actually get stuff from this farm, which is fantastic. It's not a dead piece of land. Great. I'm just making up numbers. Growth. Do you think that buying $100,000 piece of, do you think Dole Plantation that bought 80% of Lanai 50 years ago, do you think that value of Lanai land has increased? Yes, right? So let's give that another 25. So interestingly here, if you take 25, 50, 75, 85. So your score is, for Dole, is 85. Cool. Take a pause on that one. Okay. Now it's very easy for us to get like the sexy stuff. Let's take the same example and let's talk about Bitcoin. Same thing, right? Capital preservation. Do you believe that you're going to keep 100% of your capital in Bitcoin and it could never go to zero? There's a good chance it can fluctuate, right? So maybe not all of it. So I'm just going to give it a little, maybe a score of 10. All right. I don't know. It's probably going to move. Do you have any tax efficiencies of owning Bitcoin? Conceptually, no, but you can do some tax loss harvesting around it based on crypto. So here's what let's give it some points. I'm just going to give it some points. Hey, I'm going to give it a 10, which does not deserve a 10. I like crypto, does not deserve a 10. Do you think you can get some yield or cash flow owning Bitcoin? There's some opportunities to do that. It's called staking. It's kind of complex to do, but let's give it some points, right? I'll give it 10. Do you think that there's an opportunity if you bought Bitcoin today at $1, do you think over the next 20 years, it's going to be more than $1? I think so. Hey, let's give it a bunch of points. 25, right? Do you see where the score is going? I got 25, 25, 50, 35, 45, 55. Now I have a score. I have a score for Bitcoin. Do you see how fast I was able to do that? Right? Otherwise, you're thinking, man, should I invest in Bitcoin? I really don't. And what happens is when we get interesting things that come to us, you start to get FOMO and you forget the pieces of the puzzle. Right? I'll give you one more so that you can see this because you can use this for almost anything. Right? Let's take Apple stock. I hope all of you own Apple stock. My kids own Apple stock. If you don't, best time to own Apple stock was 20 years ago. Second best time to own Apple stock today. Right? This is not financial advice, but you should go buy Apple stock. That's what I mean. So here's what I'm saying. If you bought Apple stock is roughly $161 right now. All right. AAPL, $161. Do you think that there's a decent amount of capital preservation in Apple stock? Do you think Apple's going to go to zero? Probably not. Right. So I'm going to give it a little 20 score. Do you think there are any tax efficiencies in owning Apple stock? I'll tell you right now. No, zero. Right. Yield. Did you know that for the $161, if you own one share of Apple stock, on a per year basis, you get 88 cents? Okay. FYI, I'm going to give that a 0. Like you getting 88 cents, it does not change your life. Okay. So if you own 10 shares of Apple stock and paid $1,600 for it, you would get $8 a year. Okay. You can't, that's like 1.5 Americanos, just FYI, right? Like just FYI. All right. Equity growth. Do you think Apple stock is going to grow? I think so. So give that a score of 25. So it's 25 and 50. So you may even say, man, is Bitcoin better than Apple? Now you have a chance to have some debate with yourself. You see where I'm going with the framework? You have a chance to analyze things very quickly, right? Anytime someone gives you something, you want to quickly put it into a framework where you can say, all right, is there some capital preservation around here? Are there some tax efficiencies around? Is there some yield? Is there some growth? Now, let me give you the last most important thing that you need to think of. Okay. Cash. Ooh, cash. Cash in your mattress. Capital preservation of cash. Man, it's not going anywhere. You get the full 25 score for it. Tax efficiency, 0. Yield, 0. Growth, 0. Cash is going to be this is why cash is your worst investment. Do you see that? Now, do you know why people don't want to invest their money? Because they don't know what else to put it in. The reason they don't know what else to put it in is because they don't have a framework to understand what else to put it in. Not because they're scared, they just don't know. They also don't know that cash is the worst investment because they have no metric to judge whether cash is a good investment or not. That's why. And since the only reason we know that cash is a good investment because you open your Bank of America account, hit refresh, and you see $200,000 there, you're like, I don't care about inflation. I feel good that I got 200 grand. I'm sorry. I used to do that. It's fine. But like I have a money coach. My money coach, you know what he calls it? He's like, oh, Sharran, you open your account, you see 200 grand in there, you feel pretty good. You know what that's called? That's called lazy cash. It's just sitting around doing nothing. And unless we find a way to do something with it, until then, we don't know that we're underperforming. Think of cash as an employee in your business, just sitting at a desk, twiddling her thumbs. Okay. That's wild. So I'm not telling you to invest. What I am telling you is that we have to get more educated on what our options are so that we can do better than cash. Model number two. You should see a bunch of dots. Okay, you should see a bunch of dots. And what I'm going to show you today is what I call the billionaire model. And here's what I mean by this. I learned this while I was an investment banker at Goldman Sachs. All right. It's a really powerful thing to look at and think about. And if I showed you and broke this down for you, like literally, you're going to tell me, okay, I'm done. I don't need to hear anything more from you. Right? That's what this perspective is going to give you. So let me first tell you what each of the axes mean. All right. Individual means what you and I as individual investors have access to. Do you believe that the bigger institutions like the Bank of Americas and the GEs and the insurance companies, the people that what we call institutional investors that can write big checks, pension funds, et cetera, do you believe and do you agree that they have significantly better access to investment opportunities than we do? Right? So they do, right? They have significantly better investment access. They just have access to stuff that we just don't. And so what happens is when stuff doesn't, when those investments only work for them, we get the worst. Like all the 80% of the good stuff goes to institutional investors, individual investors. Do you know why the average entrepreneur like you and me who make good income but get bad advice? Because all the good advisors are at Goldman, right? I will tell you, there's a good chance that you have a financial advisor that didn't have a chance to actually get 39, like they got rejected by Goldman 400 times. They didn't get 39 interviews to get there. I'm not saying I'm special. I'm just saying, did you know that I actually went through a 6-month training program at Goldman? They paid $1 million for me, just me, to get me trained before I could make one phone call to talk to a client. That is crazy if you think about it, right? No wonder they put 39 interviews because my MBA graduating class had 29 kids from around the country, 29 kids, right? So the reason is 80% or more of the best investments in the world go to pension funds, institutional investors, high net worth folks. All the rich dudes and companies get all the access to stuff. And we don't. And because we don't, we get taken for a ride by really crappy advisors and shyster syndicators. That's the problem, right? So I just want you to understand that is the entire idea of this. You will see people call this a retail investor. Meaning, even though you have 100 grand to invest, it's not 100 million. 100 million will get you a good investment. So a big thing, what I want you to think about here, institutional just means that they have a lot of dollars. Individual just means that they have a little less. All right. That's the scale of institutional, which means more dollars up there, lower dollars down here. That's the y-axis. All right. The x-axis is easy to understand. The farther right you go, it's lower risk. The farther left you go, it's higher risk. So just give me a nod if that kind of broadly makes sense, right? So you're like, all right, Sharran, what are these dots? By the way, you can do this. You can do this in your own companies. You can do this if you're doing Bitcoin. You can do this if you're doing stocks, if you're doing this with real estate. But I'm going to show you how real estate works and how all of this kind of shakes out. I will just, I'm colorblind, by the way. So I think there's reds and pinks and greens. I'm not sure. But it's colorful enough that it makes it exciting for me. So hopefully it's exciting for you. All right. So here's what I'm going to take you through. I'm going to take you through everything from down here, which is like the individual high risk, the stuff that we're told to do, which is actually bad. And I'm going to take you to up here, which is what institutions get and how you can get some of this. Cool. You want to play in this box. That's where you want to play. but no one tells us how to play in that box. I'm going to show you how to do that. So let me tell you what each of these look like. Number one, this little red dot down here is, I'm going to call them timeshares. This is what all of us get sold, and it's the riskiest, worst thing that you can invest in. That's why they have, hey, come and do a timeshare presentation and I will give you a sunset cruise. Do you think Goldman is going to a pension fund and saying, hey, come and sit through a presentation, I'll give you a steak dinner? No, they're trying to incentivize you to do something that is like really lucrative for them and not for you. Timeshare is worse investment, by the way, right? Here's the next thing that we've all been told. Hey, you should buy single family real estate. So it's called single family residential. Buy your first, no matter what it is, just buy your first residential real estate property. And then that's how you learn. Just not if you've ever been told that before, right? There cannot be anything riskier than that. It's the worst thing you can do. Because you know why? I did it. I borrowed 20 grand from credit cards. I bought a $100,000 property in Mount Shasta, California. I've never seen it. And it was $1,000 a month. I roughly made $100 a month in net profit from that property, $100 a month. 4 months in, the water heater broke for $1,400. Okay. 3 years. I had that for 3 years. I sold it for a $3,000 profit. 3,000. So I made 3 grand, and then I paid 20% in capital gains, right? Then I paid the agent. So I made net $1,800 from owning this real estate investment. Boo-hoo. Go ahead and buy Apple stock. Way better, 88 cents of dividend, right? It's crazy. Now, the only thing better than that is to buy 5 of it. It actually, like, if you buy 5 of it, it actually makes sense. You're like, you know what? I have 5 of these and I spread my risk out a little bit. The other thing is, you might have heard of it. It's like, hey, if you're a sophisticated investor, buy duplexes and triplexes. That's actually a good idea. Duplexes is 2, triplexes is 3, quadplexes is 4. That's good. Anybody just give me a wave if you've ever done duplex or triplexes ever? Okay, cool. That's actually better. But think about it. It's better because a lot of institutional investors, banks, et cetera, want to invest in that stuff because you have multiple people to move the risk around from. So it's good, right? Let me take you even further in this game, right? Which is, you may say, well, what is this guy right here? This guy is commercial, owning a strip mall or a piece of a strip mall, et cetera, or a office building. It's good. By the way, if you can own your own office space or office building and your business pays you rent and pays off the mortgage, great idea. I would highly recommend you do that. So if you own your own real estate and your business has to pay rent anyway, that makes sense to own your own real estate. Heck, I'll tell you exactly what I did. One of my friends owns a law practice. Okay. He owns a law practice. And I was telling him about, like, he's like, I love my building. I should stay in my building. I'm like, why are you paying rent on the building? You should own it yourself. And it was a small building in Allen, Texas, $1 million building. And he's like, hey, I'm like, well, I don't have the $220K for the down payment. I'm like, bro, I'll give you the 220, right? You pay the loan to the bank. We get a loan to the bank, and you pay the loan to the bank, and you pay me a little bit. And then as this increases, I'll refi my position out. He's like, you do that for me? I'm like, yeah, I'd much rather you own this because you're paying rent anyway, right? If you have an office space or a salon or whatever, and you can own that space, or you can move into a freestanding building to own that space and pay the rent to yourself to pay the mortgage payment, I'm just going to offer to you, it's a good idea to think about it, right? Because it makes sense because you're going to stay there anyway. You might as well have the rent that you're paying anyway pay down your mortgage. It actually helps, right? So commercial. That's a little risky, but it works because you have to do tenant improvements, et cetera. I will tell you a couple other things. Some of you may have heard of storage deals. It's self-storage and things like that. Actually pretty good, by the way, but it's open to more individual investors. It doesn't have institutional growth. It's like steady Eddie and it works. But the problem is, if you don't know much about storage and depend on the operator, anything can happen. Like pandemic happens, they do random storage laws, wild things come. So you have to have a good storage operator invest in storage, but generally the returns are lower, right? Because it's storage and that's how it works. Here's the worst. I'll write it in red. This is the worst. Syndicators are the worst. You're seeing that I don't share this with any syndicators, please. If you're a syndicate, I love you. I'm sorry. I don't mean it. Syndication, good. Syndicator, bad, right? The reason is a lot of them they just want to put a deal together and then let the real estate do itself, not run the business. And so I'll tell you why that isn't in a case. But here are the 3 things that I really want to show you. Number 1, number 2, and number 3. Those are top right. Those are what you want, right? You want institutional-like assets to invest in. You want stuff that the banks and the insurance companies are investing in. You want that so that you can invest in them, right? So here's what they are, but they're hard to get access to. They are industrial. So if you own an Amazon warehouse, Amazon will sign like a 20-year lease with you. Really good. Hard to get it, but really good, right? There's some, if you're really bored, you should research this asset class. It's called MLPs, which are master limited partnerships. They're publicly traded private partnerships. Essentially, all they are pipelines, meaning Sharran owns a network of pipelines. Chevron pays Sharran a toll to utilize the pipeline to send gas through it. Okay. BP pays Sharran a toll so that they don't have to build their own pipeline. So I own a network of pipelines, and then all these big oil companies, natural gas companies use my pipeline to sell. And it is an insane business, but you can actually get access to it. And at some point, I'll give you some information around that. But the most important thing is what you want institutional class multifamily, meaning you want good operators running your deals, like the fact that big companies and big organizations are investing in. You want access to investing in operator-led institutional class multifamily deal, because that way you know that everything is buttoned up. And the person that is buying the deal is the person that owns the deal, is the person that operates the deal, is the person that you call for something about the deal, is the person that sends you the check every month, is the person that actually you talk to if there's a problem. It is the person that we buy, own, and operate that real estate. The best, which is why this is really important. So you want institutional class multifamily, not individual class multifamily. That's the big difference. This delta is where people get taken for a ride. And that's what breaks my heart. Okay. So it's funny how we didn't talk about multifamily at all, but I want to give you this. Does this, I'll pause for a second. Is this helpful? Just to kind of go through this, it's kind of broadly helpful. Anything that, before I kind of break down multifamily, anything that comes up, question, thought, idea, as I break the rest of it down. Clarify institutional. Okay, great. Paul, institutional is anyone that can write a really big check. Institutional is more organizations, pension funds, insurance companies, banks, university endowments, pension, small like family offices, ultra high net worth people, foundations, folks that can deploy large amounts of capital, get access to better deals, right? Who owns institutional multifamily? Great question. The only people that own institutional multifamily are funds who actually buy the property and operate the property as well. Because what a pension fund, what the Hawaii Fireman's Fund will do is they won't invest with the syndicator, because the syndicators come and be like, whoa, give me 200 grand, right? That's what a syndicator does. But a fund will say, hey, I'm here for 5 to 7 to 10 years till I buy a bunch of assets. Now, a pension fund wants to invest in that because they're like, hey, I want stability in my stuff, and I want to make one call to know who's actually operating this asset. What you want is access to what those folks are investing in. That's what's cool. And the interesting part is that's hard to get, right? And I'm going to show you how to get access to some of that. Great question, MLP stands for Master Limited Partnership. Master Limited Partnership. You can Google it, Master Limited Partnership. It's publicly traded, by the way. So you can go to your TD Ameritrade or your Charles Schwab account and buy an MLP stock. It's super easy to do. So you can actually do that. And it's, so take a minute to read up about it. That's probably a separate training in and of itself, but a very good thing to think about. Let me break down multifamily for you. So whenever, I want to show you how you ask questions and how you think about, when I say asset class, how you think about multifamily as a whole. I just want to show you how to think about it, because the average syndicator will tell you to ask syndicator-based questions. I want you to ask institutional-based questions, right? Because if you think like an institutional investor, you think like a true investor. If you think like a syndicator, they're just trying to sell you something. So here's how you think about the asset class. I promise you, after I just finish this little triangle, you're going to be like, I know how this works. And that's like, if we get done with this and you don't say, I know how this works, I have failed and not done my job. Okay. So here's how this works. Every investment sits on the underpinnings of the macroeconomy. So if someone ever tells you, oh, this asset will do well regardless of the economy, they are lying, right? That does not work like that. There are times where a certain asset class does well, and there's certain times where it does not do well, right? So we're actually very fortunate right now in the real estate world. Like, as you see rising rates, that means that as you see rising inflation, means the cost of things are going up, right? When cost of things go up, that means cost of real goods will go up. Cost of real good means hard goods. And as the cost of hard goods go up, real estate will go up. Then that's why it'll actually benefit from that. When it's the reverse, you actually don't want this, But that's when you want something different in cash flow. So I'll explain that in a second. So number one, you should be like, okay, where are we in the macroeconomic cycle and does this make sense? But here's the number two part, right? A geographic market is very important. So we get deals, like based on my network, I get access to real estate deals everywhere in the country, right? So for example, we don't buy real estate deals in the state of California. Reason is most parts of the state of California and multifamily have rent control. And it's not good or bad, but if you have rent control means like, I can't change this $1,000 a month rent. If I can't change this $1,000 a month rent, I can't make more money on this unit, which means I'm stuck, right? So I can't actually deliver more returns. But so we only invest in the Southeast, Senator Atlanta, in the greater Southeast. So we buy assets in Georgia, Alabama, North Carolina, South Carolina, kind of inland Florida, and Tennessee. That's our kind of market. We call it the Southeastern Sun Belt is where we buy stuff, because for two reasons. Number one, very favorable, no rent control. So no structural issues to raise or change rent. And number two, insane growth, because post-pandemic, everyone is like, hey, I'm not paying, $42 million to live in a shack outside of Laguna Beach. I am going to go to Arkansas or Tennessee and get XYZ, right? So that's how they're thinking about it. Now all those markets are kind of doing well, but you're seeing a lot of growth there. So number two is the geographic market. Here's where, once you have these two, that's when it really allows you to think, because if you're talking to a syndicator, you should say, hey, you're buying this property in Phoenix. Here's a question I would ask. My friend has a great deal in Indianapolis. Would you like to take a look? And you know what they'll say? Oh yeah, I really want to take a look. That is like, I'll take a deal anywhere so that I can get a fee. You tell me, hey, I have a deal in Indianapolis. I'm like, no, thank you so much. I really don't want to. If it's not in the Southeast, I do not care how much money it pays me, right? Giovanni says, it's good to buy in Puerto Rico. I would suggest not, because I am not 100% sure of the Puerto Rican growth of the economy as a whole. So I'm not, but if you want to live in Puerto Rico and get 2.7% flat tax, you should totally do that, right? Here's number three. Based on all of that is where the asset sits. So if I say, hey, if this market's growing, it's working in Atlanta. Atlanta is seeing 23% year over year job growth and GDP growth in the Southeast. We're buying this in the growth corridor of Atlanta, where everyone is moving to. Oh, cool. Now I understand the value of that asset in that marketplace. But here's the crazy part. This is what everyone will sell you on, but it's not enough, because none of this matters. Here's the crazy part. None of this matters. You know why? Here's why. Because there is a business that sits on top of everything. And it's the business of renting apartments out to people. The entire job of all of this is to run the business. The value of this asset is based on the business. It's not based on the asset. It's not based on the geographic market. It's not based on the macroeconomy. It's based on the business, which is why a syndicator normally will put a deal together and then give it to a property manager. You know what they'll say? Well, I have an on the ground team that best in class property manager that manages this property. You know what a property manager does? Pays bills. Property managers pay bills. Asset managers operate the business, right? Property managers pay bills. Property managers wake up every morning, go to the office, rent another unit, and pay the electricity bill. That's it. So the idea, and it's not good or bad if you have we have on the ground property management, but we have an asset management team on the ground holding our property managers accountable to run a business plan to grow this asset. We run the business. It's not about when you invest in real estate, it's about how you actually run the real estate business. And let me tell you why this is important. All right. So if you are not paying attention at all, these next 16 seconds are the most important part of today. Okay. That's all you need to know. When you run the business, many of you run an active business right now, and you probably know two numbers. One number that you know, one number that you don't know. You probably know a net income number. I hope so. Probably know a net income number, which is your profit. In the investment world, that net income number is often referred to as EBIT or EBITDA, which is earning before interest, taxes, depreciation, amortization. That's how you actually sell your business, right? Essentially, think of this as modified net income. So don't overthink it. That's all it means, right? Here's the crazy part. The business of operating an apartment complex is called NOI. You may have heard of this. It's called net operating income. And the value of this apartment complex is a multiple of net operating income. So if my net operating income is $70,000 net at the end of the day, say about $100,000 in rent, and I had $30,000 in expenses. So my value of so I have $70,000 in net operating income a year. Does that kind of broadly make sense? Based on the area and the multiple, you may say, hey, the multiple for this, pick a number, is 7x, which means this apartment building is worth 490. It is entirely based on one number, which is this net operating income. Now, there's also a prevalent number, which is this multiple that changes from marketplace to marketplace on how the economy is doing, et cetera. But if you run a good property, if you run a good asset, you run a good business, and the net operating income makes sense, you will make a lot of money. We will make a lot of money. Well, what most people will tell us is, oh, let me tell you about this asset. Let me tell you about where it is. Let me tell you about how awesome it is. Let me tell you about how I tied it up. They'll tell you everything about this apartment complex, but they'll never tell you about how they're going to run the business associated with it. Running the business is what the net operating income of the business is what drives the value of the business. You literally don't need to know anything else, right? So when you're talking to a potential multifamily deal investor, you say, hey, can you give me a sense of what the net operating income is? They'll say, oh, it's $70,000. And you're like, per month or per year? Because they'll randomly say stuff. Oh, per year. Great. What multiples are they trading at? Which means what is the multiplier of the net operating income in which you get values? And they'll say something like, oh, it's somewhere in the 4 to 7. 4 to 7. Like that's a range that is crazy. That is, if you took a $70,000 investment, that is somewhere between $280,000 and $500,000. They're giving you a 50% spread in value. Punch them in the face, right? Welcome to syndicators. That's why they're shysters, right? They want to put the deal together, get you to invest, and then they walk away. If I have a building today that makes $70,000 a year in net profit, right? So take your business. Say you have a business. Say you run a salon that makes $100,000 a year in net profit, and I wanted to come and buy it, right? And I said to Becky, I said, Becky, your business makes $100,000 a year. I'm going to pay you $100,000 to buy it, right? And Becky's like, well, it's interesting because I may sell it to you because I don't want to, but otherwise I can just stay in my business right now and make the same $100,000. Why would I sell it to you for $100,000? But instead if I told Becky, hey, I'll pay you $400,000 for the business. Becky's like, that's interesting because now in 4 years, I recoup my investment. And Becky's like, well, that makes sense because now I don't have to work for 4 years. And I've built this over time that is guaranteeing me this. That's how multiples work, right? And it's the same when it comes to multiples for a real estate asset. So if I owned a real estate building that had $70,000 in net profit, and now you came and just bought it and you did nothing, you would hypothetically continue to make 70,000 unless you ran it into the ground, right? But most people run it into the ground. That's the problem because they don't pay any attention to it. So what the market says is the value of this is some multiple of that. So multiples are very, very standard. So for example, Facebook trades at a 20x revenue multiple, meaning if Facebook made $1 billion in revenue, not profit, revenue, the valuation of the company is 20 billion. I'm making it up. I don't know exactly the numbers, but they trade at revenue multiples, right? Service businesses like what we have trade at a multiple of profit or net operating income. Trading in multiples is good because you will not sell your business or an asset for the same thing that is producing on an annual basis. Good? Helpful? Tia asks, how do you know what the multiple should be? You don't. That's why you need to know exactly what's happening in that marketplace. So if someone says, hey, the multiple is 21, you can say, oh, great. Are there other deals that have happened in the last 3 months that are the same multiple, right? So that's what real estate comps are, right? What else is the market trading at? So that's how you ask. You have no idea. You will never know. But some Indianapolis trades at a different multiple, Atlanta trades at a different multiple, Miami trades at a different multiple. So if I bought a $70,000 net income property in Miami, I would pay more than if I bought a $70,000 net income property in Indianapolis. Like that makes sense, right? From a real estate perspective. That's all this is. So you would never know unless you look at the comps and know the market, which is why our team knows Atlanta inside out. I used to live in Atlanta. We have a team on the ground in Atlanta. We only hire people in and around the Southeast. I live in California as a asset manager, but all our team is based on the ground and they run the business from there. They work for us, not the property management company, right? So their job is to know. So if we buy a property and they're like, oh, the 2 bedrooms in this apartment complex are $1,100 a month, my team will be like, Sharran, we should buy that. I'm like, why? They're completely underpriced in market because they know every rent of every building in like a 16-mile radius. So now they're like, oh, if we bought this, we can change the rents because we know that the market actually can bear them. That's why knowing that is really, really important. That's why a property manager can't do it. An asset manager who runs the business knows the value of it. I compensate our asset management team on how they run the business, how they increase net operating income. When they increase net operating income, all our investors make more money. Talking about cap rate and stuff. So these are the only 4 terms you should know. Only 4 terms you should know. You're going to hear them. I'll tell you what they are very quickly. And you're probably not going to remember them, but at least you'll have an intro to them. I just want you to know one thing. None of these are hard. If you ever want to Google them, you can, but I'll give you a very quick intro into what each of these are, right? But you should kind of at least have heard them so they don't feel like foreign terms. So number 1, a cap rate, here's the calculation for is NOI, you know what it is, net operating income over value. Essentially, they're saying there's a percentage for that. Meaning, let's say there's a $70,000 net operating income that we just talked about. And let's say the value of the property is $1 million. That means the cap rate 7%. I use 1 million so I can do easy division, right? That kind of makes sense. All right. That's literally all you need to know. The cap rate is just a multiple. All right. That's number 1. The other thing that you're going to hear is something called a price per door. This is how this works. This is the total value of the property divided by the total number of units. So if I say, it's a $1 million property and it has 200 units, that means each unit is worth $5,000. That makes sense? Hey, so the people will always say, hey, I paid $5,000 a door. You'll hear that language and terminology a lot. I paid $5,000 a door. I paid $100,000 a door. That's what people will hear a lot. I just want you to know what that means. It's the value divided by the total number of units. When we make offers to buy buildings, we don't offer $30 million. We offer $170,000 a door. So just so you know the terminology of how that works. All right. You're going to hear this a lot. People will say things called the GPLP, value number. Leah, that's a good question. The value number is just like whatever you bought the property for or whatever the seller wants to sell the property for. That's what the value number is. The cool part about this, think about this, right? For a second, you will always know at least 2 of these things, right? So you'll know the prevailing market, the cap rate in a market, and you will know your net operating income, and that's how you come up with your value. Or you will know what you bought it for and your net operating income, so you can come up with the cap rate. It's just 2 out of 3. Good? Okay. This is like basic math, but once you know it, you're like, oh, I see what's going on, right? No one will tell you. That's how it works. GPLP, you'll hear algebra. I know, crazy, right? GPLP, right? GP stands for general partner. LP stands for limited partner. Let me tell you, the words don't mean anything. Let me tell you what that actually means. A limited partner is an investor. So essentially you would be a limited partner in our deal. A general partner is an operator. So the general partner takes the risk, does the deal, etc. The limited partner generally gives you the money. So this would be the GP and the LP. All right. So here's what's, and I told you how syndicators make money. Here's what syndicators will do. Put a little red thing in there. Syndicators will say, hey, when I acquire this asset for $10 million, right? And I'm going to get a loan for $8 million, I'm going to raise, and I need to come up with, pick a number. I need to come up with 20%. They'll raise 2.1 million. And then they go 2 million and 8 million is 10 million. And then this other 0.1 is 100K, which is now their fee. Get it? Very rudimentary. There's a little bit more of a complex calculation to this, but what happens is from the total raise of the deal, they would have not put any money in. You put all the money in. They got this from the bank, but they still walk away with $100,000. It's fine. I actually don't mind this. Hey, and a lot of times we do this too, but we take that and I use that fee to pay for the asset manager that's going to manage the property. What syndicators do, they'll take the fee and they'll run to the next deal. That's what I have a problem with. I don't have a problem with people who operate the asset getting paid to run the asset. I have a problem with people who put the deal together, get the deal. They should get paid. I understand that. But then they run away to their next deal. And that bothers me, right? Because I want to make sure that anybody who gets a fee is paid to increase net operating income. That's all. That's all I want. So when we make a fee, I give it to the asset manager. I make zero money because at the end of the 5-year period or whenever we sell it, when we sell it and all of you get your money back, that's when I make my profit, right? I want us to be incentivized so that every piece of fees or monies or whatever paid goes to the people that are helping increase net operating income. Very singular focus. Okay. Last but not least, you're going to hear this term. You need to know what this means. So please pay attention. I will help you in on a lot of things. Probably no one ever explained this to you. This is called internal IRR, is called internal rate of return. Just give me a nod if you've like people have dropped IRR or talked about this to y'all. Even the most sophisticated investors don't know how to explain IRR. Okay. So let me explain what this means. This is essentially talks about an annual rate of growth. And I'm going to give you the easiest way to think about it. Okay. IRR essentially is how fast you double your money. Okay. So think about IRR as how fast you double your money, So I'll give you a very simple example. If you double your money in 1 year, the IRR is 100%. So someone says, I have 100 IRR. That means there's 100% IRR, which means I put in 100 and I double my money in 1 year. Okay. So now say it's a 3 year, right? You may think 3 years, 33%, but you don't need 33% a year for 3 years because it's compounding. You need less than that, right? So roughly a 3-year IRR roughly is 25%. 25% the first year, earns a little bit more, 33% the next year, earns a little bit more, and then gets 100. So it doubles in 3 years, means it's a 20, that means it grows at roughly 25% a year compounding. If it's a 5-year, if it takes 5 years to double your money, which by the way is fantastic. Can you imagine every time you put $100, $200 popped out in 5 years and you didn't have to do anything with it? That's cool. This is called 15 IRR. I say this for one reason. We try to model that. We try to build our investments to 15 IRR, meaning Becky puts 100 grand in, roughly in a 4 to 6 year period, I want to give Becky 200 grand back passively for her to do nothing. That's how we model our investment. Does that make sense to understand? Like, hey, that's what IRR means. It's how fast money doubles. By the way, it's very confusing from time to time. If you ever get stuck, just Google. Someone said 15 IRR, just Google what is 15% IRR and you'll figure it out, right? But I wanted to give you the feeling around all of it. Last but not least, you will hear this word called value add. You'd hear this word called value add. Anyone, just give me a nod if you've ever heard value add. If you ever hear value add, here's what people are saying. Hey, I'm going to buy this property. I'm going to add value to it. Add value to it. No one will tell you what that means. I'm going to add value to it. And you can say, what do you mean add value? Well, there's only 3 ways to add value. And let me show you what that is. I'll give you some examples. You can increase revenues. You can, because remember, it's all about the NOI or the operating income, right? You can increase, you can increase revenues. How do you increase revenues? You can increase rents, which is not easy to do. You can increase services, meaning, hey, I'm going to have a cleaning service for that. It's an extra $30 a month. Or you can increase fees. Hey, if you have a big shaggy dog, you're going to pay a $50 fee. Those all like add up in an apartment, right? To increase rent, most of the time you have to do what we call CapEx, or you actually have to do physical improvements to the property, which means you have to like pay money to do that. And then you can increase rents. Okay. Operate efficiently. This is your straight up P&L. How do you run the business better? Right. And then you can actually restructure deals, which is you can restructure on equity, you can restructure on debt, and you can restructure on legal stuff. When someone says, I want to value add, your question should be, oh, explain. Oh, we're going to do market rent increases. You're just going to go and increase the rents? What about the people that are already in the apartments? Average syndicator can't answer that because they don't operate. I mean, let's say Chris was in an apartment and she had a 2-year lease. How are you going to increase Chris's rent? You can't just go to Chris and be like, hey, starting August, now you're paying like $1,800 and not $1,400. You can't do that. So everyone's projections are off because they think they can do that, but their modeling is off because they're syndicators and not operators, right? I'm going to show you a couple examples. Then we'll take a break. Feel good. I want to fire through like feel good. This is good. Helpful. Let me give you like 3 examples. I think this will really help you. So we bought this property for $20 million. And in 15 months, we sold it for $37 million. 15 months. In our IRR, it's up 47%. So in 15 months, we doubled their money in like 18 months, 18 months. That's wild if you think about it, right? All because we operated the property. Yeah, we got lucky with some market stuff, but we operated the property, all right? Here's this. We actually own this right now. It's 294 units. We bought it for $106,000 a door. Remember I told you about the price per door? Right now, we haven't sold it yet, but right now a broker is giving us an offer for $155,000 a door. So over almost a 50% increase in that. We have not sold it yet because I want to milk it some more, right? This is the property I want to tell you about. Crazy, insane story, right? You'll really, really appreciate this. This is what most syndicators won't do and most operators want to do. So it says 120 units, but we only bought 114 units because the other 6 units were owned by random individual people. So it's a really weird deal. And nobody wanted to buy it. Banks didn't want to lend on it. They were like, Sharran, you're not even buying 120 units. You're buying 114. They called it fractured. So I was like, there's only 6 people that I need to go buy these units from. I went and door knocked each of these 6. I made them hand cash offers and I bought all 6 back, right? This increased the value of the property $3 million. Just me going and buying what I would have bought anyway. That owner who owned it before could have done it himself, but he didn't because he's lazy, right? Like, imagine, hey, knock, knock, Kelly, I know you own this property. I know you bought it for $70,000. I'd like to give you 200. Would you like it? And you can stay in it. Give you the 200, stay in it, and I'll give you rent, and you can pay rent. How amazing is that? Literally, that's all we did. Hey, you like living here? Awesome. Here's a check. Keep paying rent. Now we own it, and it's instantly better. We bought it for $212,000 a door. In 100 days, now it's worth $257,000. In 100 days, all I did, I didn't do any. Think about this. I made no changes to rent. I made no changes to the property. I spent no money. I hired no new staff. I didn't change the landscaping. I didn't change the sign. I did none of that. I just bought the 6 units. And then there was an HOA. I collapsed the HOA. $42 state filing fee. That's it. Increase the value of the property, $3 million. Why? Because operators run the business, right? Everyone else was too scared to do that. And I was like, I'm happy to go to Atlanta and knock on 6 doors, right? It was one day. I did it all. It was done. So we did a 5-year business plan in 100 days, which is wild if you think about it, right? This is having an institutional class asset that you guys can get access to as investors, which no one offers otherwise. One last thing. Let me give you let me walk you through our fund really quick, right? So here's what our fund, please, I'm not selling on anything. I'm just giving you some perspective. Here's, we're launching our fund number 2 right now. Our fund number 2, here's how it looks. It's roughly 50 to 100 because we're going to close it at any time. So we didn't put a number on it. So it's roughly 50 to 100 million we're raising. We're going to buy 6 to 10 assets and it's going to be 5 to 7 years. Our current investment is $100,000 minimum. And we have not even opened the fund yet. So it's like 12 to 24 month period. And we're going to buy a bunch of properties. So this is what our fund looks like. So people are going to give us money. We're going to take that money. We're going to go buy stuff and we're going to operate these properties. Meaning we're going to buy it, operate it, work it, sell it, return money. Like we're going to own everything. So if you called my team, I know everything about everything. I'd not be like, ooh, let me check with the property manager. No, I know everything because like that's my job, right? I run the business, right? Traffic Waze. Traffic reported ahead. I know that sound. I have that same gal tell me stuff. I am not going to go through the sample investment, but here's all I wanted to show you, right? What I wanted to show you was, you don't worry about that. I'll give you the slide. Essentially, if you put $250,000 in a year over the course of 5 years, the goal is to spit out 470, right? Passively, meaning you don't do anything. That's the entire idea. And so including cash flows and including the sale of the property, that's what gives you that. So you get some cash flow during the years 1, 2, 3, 4, 5, and then you get that overall. So that's how I'll send you this. Hopefully that's helpful to you. Here's where we are. And then I'm going to go, I told you I would show you the 5-year double. That's all I wanted to show you. So right now we are going to raise this fund 12 to 18 months. We have not launched it yet. It's not even live. You can't even invest in it. We wrote 3 emails and did 1 webinar. We have 70% of our fund committed. And we have 21% of our fund in the bank. I have people that have wired me money without documents. Hey, Sharran, just take my money. Like, I want to be first in line. And I'm like, I don't have any documents. It's like, I trust you, take my money. I have money sitting in an account with no documents. People just wired us stuff. This stuff is crazy because would you wire a random syndicator money? No, right? Operators win. And you want to like bet on operators, right? That's why this is really important. So second piece of this, if there were 2 times you paid attention today, it's going to be this. Time number 1 was you realize that every time someone tells you anything, you are going to focus on the running of the business. The net operating income is what drives the value of the property. That was thing number 1. Thing number 2 is what I'm going to show you right now. It'll take 2 minutes. I had this idea. I was thinking my daughter, Laura, is 6 years old. She's going to be 21 in 15 years. Math, not even algebra, arithmetic math, right? 15 years. So I was like, how do I set her up for success? How much do I have to invest every year to get her to work well? So I was thinking, man, this gets really expensive. If I have to put $100,000 a year for the next 15 years, like that's a lot of money. But I had this idea. I said, well, if the money doubles every 5 years, I only have to invest for 5 years. So let me show you. If this doesn't blow your mind, you and I are not going to get along. Okay. So if this doesn't blow your mind. So This is the first 5-year chunk, second 5-year chunk, third 5-year chunk, fourth 5-year chunk. I'm sorry, not fourth 5-year chunk, right? That's what this is. So let me explain how each of these work. So year one, this was the epiphany that I had. Year one, I put 100 grand in. Year two, I put 100 grand in. Year three, into our fund, I put 100 grand in. Year four, I put 100 grand in. Year five, I put 100 grand. I'm just making up 100 to make numbers easy. Okay. 100 grand, right? By the way, after year five, I'm done and I never have to put a penny ever in for Lara ever again. Here's how this works. Because it's a 5-year double, what year one to year six, this is year 6, 7, 8, 9, 10. Year one to year six, she now makes 200, right? But year seven, she makes 200 again. Year eight, she makes 200 again. Year nine, she makes 200 again. Year 10, she makes 200 again. Wait a minute. What happens in year 11? Now she makes 400. Wait, she waits the next year. She makes 400 again. She makes 400 again. She makes 400 again. She makes 400 again. All from the first 5 years. Let me show you this. Then she makes 800. Then another 800. Then another 800. Then another 800. And this continuous 5-year double goes on for life. If I only invested one $100,000 investment, 5 years later, it would become 200. 5 years later, it would become 400. 5 years later, it would become 800. When she's 25, she would have 800 grand for the first 100 grand that I invested. But if I did 100 a year, the money would double every year, starting year 6 for the rest of her life. That should blow your mind. Tina, no syndication, but we would manage that. So syndication, so like, if, for example, if you, yes, you would get a new deal, but let's just say we would have a fund and we would just continue to roll, right? But yes, we would continuously roll. So you would do a new deal every 5 years, assuming that that's how this worked. So a lot of our investors just continue to roll their money, and that's how you get the tax advantage. Does that help? That just unlock your mind on like, if you invested 10 grand a year for 5 years and you never had to invest again, every year your money would double for life. How wild is that? Right? So I gave you, as I promised, I gave you, Leah asked a good question. How do you guarantee that it actually doubles? There is no guarantee. Here's how it works. Our model works in such a way that we believe that every investment that we do is a 15 IRR, meaning it doubles somewhere between 3 and 7 years. So on average, 5. The couple of deals that I showed you, one of the deals doubled in 15 months. Some deals will double in 6 years. So on average, our projection is that you'll get 2x your money in about 5 years. So it'll vary, but there's no, welcome to investing. I have lost a lot of money. There is no guarantee, right? But you just want to go with the model and you want good operators that are on good business. Appreciate you guys. Have a great day.